Hello, guys. Thank you so much for being here. I'm happy to be here. Glad you showed up tonight. What I want to talk about tonight, guys, and let me know that you can hear me by giving me a thumbs up in the chat, real quick, if you will, guys. What I want to talk about today is 5 ETF mistakes that smart investors make. And I see it on a regular basis. Now, as you come in, let me know where you're coming from, guys. I always like to see where everybody's from. Looks like we got some folks already here. KC Mo is in the house. Good to have you. Westchester County. Excellent. Thank you so much. I do have a backup plan in case my mic goes out. Something crazy happens. Asheville, North Carolina. Good to see you. Thank you so much for being here. Another person from North Kakalaki. Good to have you. So as you come in, drop that, guys. I want to see if I know where you're coming from, if I can read it. Let's see here. Looks like we can kick somebody out already. Woo, that was quick. Listen, as of early this year, 2026, we're going to get into this right away. As of early this year, 2026, several estimates are out there. Now, I've looked at several studies and some say different things, but somewhere around the estimate is about 25 to 30% of all US households in America own some form of a mutual fund or an ETF, right? ETFs alone are about 20 to 25% in several of the places that I read. Now, it's also noted in the studies, in the documents, in the research that around 50% of ETF investors started investing in the last 5 years. What's that tell me? A lot of folks that invest in ETFs are younger, right? A lot of folks and a lot of people are investing in ETFs. Look, 20 years ago, 30 years ago, ETFs weren't nearly as popular as they are right now. But right now, very popular. Okay. So ETFs is a big deal. And that's why I think it's important that we talk about the mistakes, because a lot of times people don't think there's anything wrong. People don't see any risk in ETF investing, right? They just go for it and do it. Oh, it's a low barrier to entry. Great. Okay, no big deal. But you got to always be thinking about risk, right? Somebody said no KC hat. I fell off. Yeah, I kind of fell off today, I guess. Um, so we got a lot of folks that are new to ETF investing, and I think it's really important that we have a conversation about it so that we can kind of ground ourselves on what things we need to be looking out for when we talk about ETFs. I did a poll a few weeks back on YouTube, and it showed I had like 10,000 votes, and it showed that like almost 40-50% of everybody was watching or that answered the poll invest in ETFs, and that's why I think it's important that we focus some time on it. I can pretty much guarantee that 99% of all of you that are over the age of 30 and invest in ETFs certainly didn't learn about ETFs in school, right? That's not when we were in school, it was stocks, it was preferred stocks and common stocks and all this stuff. We didn't hear anything about ETFs. At least I didn't, right? If you're older. Nowadays they may be teaching it. But you might have learned about all the other stuff, but ETFs is something that really wasn't taught to a lot of us. So I want to spend time talking about these 5 problems specifically. And bear with me, if you're an ETF investor, do me a favor and give me a thumbs up if you invest in ETFs. Just put a thumbs up right there in the chat. Be sure to hit the thumbs up also. Give me a like on this video, right? But give me a thumbs up if you're an ETF investor. I want to make sure I know who I'm talking to here. Before we start, let me just say this before we get going. As you put that thumbs up, so we're all on the same page, because everybody doesn't know exactly what an ETF is, right? I see a few thumbs up. Excellent. Looks like we got some ETF folks in here, some investors in here. So just so we're all on the same page, because we might get some thumbs up, but it might be somebody tuning in and saying, man, I don't even know what an ETF is. What are you talking about? An ETF just stands for exchange traded fund. Keyword traded. We'll talk about that in a bit. But it's essentially, an ETF is essentially, basically, it's a bucket of stocks. A bucket of stocks thrown in the bucket, that allows you, it could be other things too, but we're going to talk about stocks for right now, that allows you to buy a diversified collection of companies. So it's 80 different companies thrown in the bucket, 250 different companies thrown in the bucket, 800 companies put in a bucket. That's all an ETF is. It's much like an index fund, but you can trade an ETF throughout the trading day. You can't do that with an ETF. So you have single stocks over here. You got index funds / mutual funds over here. ETFs are kind of in the middle a little bit. There's still a bucket of stocks, just like index funds and mutual funds. But it's still but you can trade them throughout the day just like a stock, right? And there's other things you can do in an ETF that a lot of folks don't do with ETFs. But the price of an ETF, just like a stock, because it's traded throughout the day, it fluctuates. I just wanted to clear that up so we all straight on exactly what an ETF is. Now, most ETF investors, they truthfully believe, and you can tell me if I'm right, guys, we got ETF investors in here. Most ETF investors automatically believe that they're diversified big time. Woo, got a lot of diversity when they own an ETF. The issue, though, is that that's not always the case. Not to the extent that a lot of people believe that they're diversified. Now, by definition, because it's a bunch of stocks in a bucket, yes, there is by default diversification in ETFs, right? But sometimes not as much as you think. Now, when it comes to ETFs, I know a lot of people believe that they're making a smart, solid, efficient decision by investing in ETFs. They're low cost. They give you a broad exposure to a lot of different companies and sectors, supposedly. They give you, so people always say, "Oh, this is smart," right? But a lot of times what I've found is when you break down the actual ETFs that people own in their portfolio, a lot of times it's the same companies over and over again, just repeated, right? And the problem isn't really what they're buying, but it's sort of how they're thinking about buying ETFs. So I say all that to say, let's jump into these 5. All right. These are not beginner mistakes. Okay. I see a lot of smart investors making these mistakes. Right. You can build a portfolio that looks right, feels right, sounds right when you tell it to other people, but it could be structurally off, wrong. And that's what we're going to want to kind of address here. Mistake number 1. Let's go ahead and jump into it, guys. Mistake number 1 is this: the illusion of diversification. Now, I sort of alluded to that already. I sort of alluded to the illusion a moment ago, right? So I think it's the best place to start. The illusion of diversification, not the illusion of inclusion, but the illusion of diversification. Most people think owning something like an ETF, let's say an S&P 500 ETF, means that, ooh, I'm fully diversified. I got all this. But what happens with some ETFs, like S&P 500 ETFs, is what we call concentration risk. Now, I'm not going to pull out the whole bag of risk that you got to be careful about, right? But concentration risk is a big one, right? For example, with the S&P 500, the top 7 companies, actually probably top 10 companies, the Mag 7, Magnificent 7, or the top 10 companies, they dominate a huge percentage of the S&P 500, right? If we pull it up, and I'm not going to pull it up on my screen, but if we pull it up and we look at, say, VOO, which is Vanguard's S&P 500 ETF. If we look at VOO as of April of this year, you got companies like, we can name them, right? NVIDIA, I think, is about 7.5% of the whole weight of that particular S&P 500 index or ETF. Apple is like 6 point, almost 7%. Microsoft, another 6%. Amazon, Alphabet, Broadcom, what's the other? I'm missing one. Meta, I think you look at the top 10, I think Tesla and I think Berkshire Hathaway has kind of got in there over Lilly over the last couple of years. But when you look at that list of the top 10 holdings that are in the ETF called VOO, like it's all tech. Apple, Nvidia, Amazon, Alphabet, Broadcom, what's the Tesla, Meta, that's all tech, pretty much, or in that tech sector, right? Only one not is Berkshire. So 9 out of the top 10 holdings by weight, market cap, in the S&P 500, VOO, or any other S&P 500 ETF is IT. 33, 34, 35%. So you got another, it's actually a little more than 500. But let's call it 500. You got another 490 companies that are doing the other 65%, and you got tech doing 35%, the top companies. So oftentimes, and that's concentration. You're concentrated in tech. So what people think is, oh, I got the S&P 500. I got this broad exposure with all these 500 different companies. It's actually heavily concentrated towards technology, right? And if you look at the S&P overall, the S&P 500 overall, it's, you know what, 7, 8, 9 sectors, when there's really generally accepted about 11 different sectors out there, right? But the S&P 500, 34, 35% tech, 10 or 11% financial services or financials, another 10% communication. Okay, that's 55% in 3 sectors. 55 to 60% of the S&P 500 is in 3 sectors: tech, communication, and financials. Now you throw in consumer discretionary, I think that's at 9 or 10% also. So you're talking about 70, 75% in 4 sectors. So you got to be really careful about thinking that, oh, I got the S&P 500. I'm super duper diversified. Yeah, sort of. In a lot of ways, VOO, which is Vanguard's S&P 500, or if you want to say IVV, which is, I think, BlackRock's iShares, right? S&P 500, SPY, S&P 500. These are all ETFs offered by different companies. All right. Now, let me just say this. I got to say this, guys. Work with me here. It don't mean that VOO is bad or having the S&P 500 is bad. I'm not saying it's bad, right? But it does mean this. You have to understand what you actually own. If you own ETFs, which a lot of you do, most of you probably do, you got to know what you have. So mistake number 1 is this illusion of diversification, when really you may be concentrated in only 1 or 2 or 3 different sectors. So it looks like broad diversification, but it's really like, okay, you got three or 4 different sectors, right? It feels like big time broad, but it's not. And if you don't understand in your ETF, whatever ETF you have, if you don't understand the sector breakdown of what you own, you may not be as diversified as you think. You may not be as spread out as you think. You may not be avoiding as much risk as you might think, right? Now, let's go to mistake number 2. Mistake number 2 is this, and it's similar, closely related, but it's overlap or redundancy, whatever you want to call it. Typically, I call it overlap. because a lot of people don't just have one ETF, although you could have one ETF and be, get you some diversification depending on what you have. But a lot of people hold multiple ETFs, and inside those multiple buckets, they're holding pretty much the same companies, right? So you get this portfolio redundancy, right? You'll see people, I'm telling you right now, there's a lot of people out there that they have VTI and they got VOO together. Or they'll hold, watch this, they'll hold an index fund like FSKAX, which is Fidelity's. Is that Fidelity's index fund that tracks the S&P 500? But they'll have FSKAX and they'll have VOO and then they'll have a little SPY. And it's like, why? Like, why do you have all of the same thing? It's unnecessary. You don't have to do that. This is why you got to know what's inside of your ETF and go to a website like ETF.com or just type it in your Google or put it in Claude or whatever you want to use. And you need to see what the overlap is between the ETFs that you have. There's no need to hold VTI, which is Vanguard's ETF that covers the entire stock market. You don't need to have VTI and VOO. VOO is covering 500 of the biggest ones, and VTI is covering off 3 or 4,000 of the other. But inside of VTI is VOO. So if you look at a performance tracker of both, they're tracking the same returns over the last 15, 20 years, roughly the same returns, right? Trust me, if VOO drops to nothing tomorrow, right? For some reason, crazy reason, VOO is all of a sudden zero. Guess what? VTI ain't nothing either, because VTI is made up of VOO. Matter of fact, VOO carries VTI, right? So what happens with ETFs, guys, let me just say it like this. People oftentimes, they mistake, watch this now, hear me out on this. This is investing 101. People mistake activity for progress. Just because you're doing a lot don't mean you progressing a lot. Just because you got a whole bunch of ETFs and index funds and stocks, it don't mean your portfolio is necessarily outperforming the person who only holds VTI for life. Matter of fact, there's a chance your portfolio might not do as well as theirs. People think the more ETFs I own, the more I see it in, okay, I'm a real estate guy, so I see it in real estate, right? People say, "Oh, I got 20 rental houses. Each one of them, they getting about $100 a piece on each one of them. Their net profit every month after they pay the mortgage and all the whatever taxes, insurance, maintenance, repairs, and all this stuff, taking consideration vacancy rates, they making $100 a month on each of those 20 doors. That's $2,000 a month, dude. Why not have two properties and make the same $2,000? Two properties netting you $1,000 a month is the same net monthly, maybe not 30 years down the road because of, you pay them all off. Now you have 20 houses versus two. But right now, two houses getting $1,000 a month net profit is doing the same work that 20 houses getting $100 with 18 less headaches, right? People think I'm doing more. It don't necessarily mean you making progress, right? So don't get trapped in this notion, this mistake that I got to have a whole bunch of ETFs. If you have one ETF that meets whatever needs you're trying to do, you're good. If you got 3 ETFs that covers you in these 3 areas that you want to be covered in, you golden, right? But you don't have to always add something new or have a whole lot, because by default, when you have one ETF, you're diversified. You got 80 stocks, 90 stocks, 500 stocks, right? Adding something new, you don't have to necessarily always do that, right? People tend to double down on the same exposure by having just multiple ETFs that hold the same stocks in different buckets. Same stocks, different bucket, right? You don't have to have VOO and then have SPY or add another growth ETF when you got one already, right? Stacking I see it all the time. People stack the same tech heavy, or here's what they'll do, right? People will go out and they'll have VOO as their ETF, right? And then they'll go out and buy single stocks, Meta, Amazon, Nvidia. And I'm saying, okay, now you have more tech. You got 35% tech in your VOO, but now you go out and you add all this other tech. Now you're really heavy. And people don't sometimes realize that, right? This is where you got to slow down when you're investing and actually take a real hard look under the hood of your ETFs, right? Because when you raise up the hood or the hood on the bucket and you got 5 different hoods to raise up and you start seeing the same stuff in each one of them, it's time to really diversify in a more intelligent way. Because what really matters is what's inside those buckets under that hood, right? A lot of repetition for a lot of people, same stuff, different bucket. I'll be honest with you. For most people, 1 or 2 ETFs is plenty. That's plenty. 3 or 4 ETFs if you're trying to touch all corners or you really love to do this stuff and you like to track it and you enjoy it and you want a little bit of exposure here and but most people, 1 or 2 ETFs covers you. People have this tendency to try to build in a whole bunch of complexity where you ain't got to be complex. So mistake number 2 is overlap. Overlapping ETFs is just simply owning multiple ETFs that hold many of the same stocks, which ultimately what that creates is concentration risk again, right? And to be honest with you, when you do that, when you overlap so much, it actually makes your portfolio riskier. Because if you have VOO and you have single stocks that are the max 7, then you're not only are you not as diversified as you think, but you're actually too focused in one sector. Let's go to mistake 3. Mistake number 3. Let me see if I got anybody chatting it up in here. Nobody's chatting it up. Okay, we quiet. The room is quiet, guys. Appreciate you loving the podcast. I appreciate that. Oh, okay. You guys are talking a little bit. I just didn't scroll down. Let's see if I got a question or something. Feel free to ask one. If I catch it, I'll do my best to answer it, guys. Going well, Edward. Good to have you here. Let's see here. Okay, let's go to number 3. Mistake number 3. I'm gonna call this one allocation thinking versus ownership thinking. Let me explain it, okay, guys? And here's what I mean. Most people start buying ETFs. Watch this now. This is very, very important. So you got to listen to this. Most people start buying ETFs as an investment with this one question in mind, because I get asked this question at least 5 times, I say about 10 times a week. What ETF should I buy? That's the first question that most people ask themselves when they're trying to invest in ETFs. What ETF should I buy? That's the question. But hear me out. That is the wrong starting point. That question, if that's your first question, what ETF should I buy? That's a mistake. I'm going to explain why. Here's why. The better question, instead of what ETF should I buy, the better question is, watch this. What is my goal? What or what am I trying to accomplish? That's a way better question. Right? And you have to ask yourself that question. What is my goal with investing in ETFs? And what am I trying to accomplish by investing in ETFs? See, because once you know the answers to those questions, it's going to help you develop your own ETF investing philosophy, not smart money bros. You can't invest like me. We're two different people with two different goals, two different ages. We got two different financial situations. The ETFs that's right for you is as different as we are people, right? I go 5'9", 210. I go 5'9", 210, right? Somebody else might go 6'2", 270, right? Totally different. Totally different people, right? Their goals and their aims and what they're trying to accomplish ain't what I'm trying to accomplish. So we can't necessarily have the same portfolio of ETFs. My goal and what I'm trying to accomplish is not your goal and what you're trying to accomplish. So don't ask the question, what ETF should I buy? No, ask the question, what is my goal? What am I trying to accomplish? Because once you know the answers to those things, that's going to help you develop your ETF investing philosophy, your ETF investing direction, your ETF investing portfolio composition. What should be in your portfolio? Well, that depends on what you're trying to accomplish. Because that answer should dictate everything after that, including what ETFs should I be investing in. So you're leading with the wrong question. Right? I could start tossing around a whole bunch of ETFs and this is the index fund and this is now if you join my Patreon, we're going to be doing a video over on Patreon in about probably a few days talking about some changes I made to my ETF portfolio. And I like to let people kind of compare what they're doing and say, okay, and ask questions. So you can join us over on Patreon. I think in the YouTube description, it's the last link at the bottom or near the bottom. If we want to go deep, but I don't get in the habit of telling people what to invest in because I don't know you. If we have a one-on-one conversation and we sit down and talk about your goals and things you're trying to accomplish, that gives me a better idea for what type. Look, if you sit down with a certified personal planner, certified financial planner, CFP, the first thing they're going to do, what is the absolute first thing they're going to do when you sit down with a certified financial planner who's been trained and done this thing for years and years and years? The first thing they're going to do is do what? You guys tell me in the chat, what's the first thing you're going to do if you sit down with a certified financial planner? And guys, you got to do me a favor and hit that thumbs up button for me. I appreciate it. Hit the thumbs up button. Share the link with somebody who you know who wants to invest or is thinking about investing. What is the first thing the financial planner is going to do when you sit down with them? If you've actually sat down with a financial planner. I don't know if you have or haven't, but if you have, what do they do? Nope. It's not look at your finances and your budget. That's not the first thing they're going to do. Nope. Nope. I'm just looking for some crowd participation. Let me help you. The very first thing a financial planner is going to do, they're not going to look at your income and your budget and all that. No. The first thing they're going to have you to do, they're not going to ask you, what do you want to accomplish? No. No, they're not going to ask you what you're going to put in investing. They're not going to ask you your goals. They're not going to ask you any of that. They're not going to ask you how much money you're willing to invest. No. The very first thing a certified financial planner is going to do is this. They're going to have you fill out a form. And on that form, they're going to assess what is your risk tolerance. What do you like? What do you don't like? What's your goals? Somebody said goals. Part of that is your risk tolerance, how old you are. They're going to figure out more information about you and what you're trying to accomplish and what your goals are in terms of your risk tolerance, right? So they got to get to know you before they can offer you the right advice. So, what I'm telling you is that when you're going to look in ETFs and investing, the first thing you do is don't ask, what should I invest in or how much money I have? Or no, ask yourself, what am I trying to accomplish? What is my goal? Yep, risk analysis. Absolutely. That's what they do, right? Your allocation, your ETF choices, your overall strategy is all determined by what you're trying to accomplish with the money. In order to get to where you want to go, you have to own certain ETFs to help you get there. Once you know where you're trying to go and what you want, then it's going to be sort of obvious which ETFs that you should buy and own and hold on to. Most people who invest in ETFs, they don't ask themselves that question first. They just jump in and start grabbing a few ETFs. But once you know why or what you want, it's going to be clear about what you should invest in. Most people don't know the why they own certain investments. Other than what I read about it, I saw it, I saw somebody talking about it, I read an article about it on Yahoo Finance. But I'm going to explain this to you. That's not investing. That's speculating, and it's risky. First, figure out what you want. Then you figure out what ETFs you should be investing in based on what's going to help you get to your long goal, your long end goal, right? And when I say that to people, they say, "Oh, I don't want to be that. I just want to fast. I want to know where can I make some money fast in ETFs, right?" That's not how you want to look at it. Because when you don't have a clear vision or a clear why, here's what happens. You end up copying other people's portfolios, right? And when you copy other people's portfolios, the suit don't fit. The dress a little tight. The shoes is flopping off your feet because you're trying to put on other people's outfit. You copying other people's portfolios. And you end up making decisions about something you didn't even really choose on your own in the first place. And that's where a lot of people go wrong. People don't connect investing to their broader aims and goals and visions, right? So, mistake number 3 is getting clear about why you own the ETFs that you own. Right? That's the third thing, getting clear about why you own what you own. Guys, you got to do me a favor. Hit the like button for me. Smash the like button. Stop what you're doing. I'm about to ruin the image in the, just joking, guys. Go ahead and smash the like button for me. Also consider please sharing this information, the video, the link on YouTube or the event on LinkedIn or on Facebook, wherever you're watching this. Feel free to share this with other people because I try to give you down to earth investing information. Not the stuff you're going to get on Kramer, not the stuff you're going to get on Bloomberg News, but what us everyday regular investors should be thinking about and should be doing to become successful at investing, right? To get better and really to make our money grow while also understanding the risk and things that are associated, right? So the least you can do is hit that thumbs up button for me and share the video. And feel free to drop a comment if you're watching this on replay, okay? Let's go to mistake number 4. This is a big one. Almost everybody does this. I'm going to keep this real. Mistake number 4 is this. Smart investors, they tend to, who call themselves smart investors, they tend to chase hot performing ETFs. Before we dig further into mistake number 4, let me say this. This is so you guys are I don't know if you know this or not, but we'll see. Give me a thumbs up if you understand this. ETFs are designed not to outperform the market. ETFs are designed to mirror the market mostly. There's exceptions, we know, but basically ETFs are the primary goal of most ETFs is to track the performance of a specific benchmark. I talked about S&P 500, that's a benchmark. The NASDAQ 100, that's a benchmark. VOO has its own benchmark. VYM has its own benchmark. VGT has its own benchmark. So the primary goal of the ETF is to track the performance of that benchmark, whatever that index is tracking. It's not to beat the market. It's a different philosophy when you're investing in ETFs and index funds. You want them to go up steadily as you're tracking that index or that group of stocks in a bucket. It could be a group that's heavily financials. It could be a group ETF that's heavily communication, or an ETF or a group that's heavily consumer staples, right? Or it could be the S&P 500 or NASDAQ that is a lot of tech. It could be whatever that benchmark index is. The goal of the ETF is to track that and track it as nicely and evenly as possible. Sometimes there's errors, right? But for the most part, it wants to track it so that as that goes up in the market over the course of 5, 10, 20 years, so your money that you have invested goes up. The difference is Palantir, as a single stock, it wants to beat the market. It wants to grow as a company. Remember, all these stocks are just companies. It wants to grow as a company and ultimately beat the market, right? So when you're investing in ETFs, understand that fundamental that is tracking a benchmark index. Now that we're clear on that, listen, chasing performance is very, very common, right? A lot of people, the first thing they do when they go to evaluate an ETF and figure out whether or not they want to invest in it is they look at the performance. But what do we know about performance? Is performance forward-looking or backward-looking? Is performance forward-looking or backward-looking? Performance is always looking in the past. Always. Right? People look at the 1 year and the 5 year and the 10-year performance of an ETF. But notice it's always looking at the past. And we know that past returns are not always an indicator. Matter of fact, they should never be an indicator of future performance, right? Because here's what happens. You got this bucket of stocks called ETFs, and inside of that bucket of stocks, inside of that bucket is a whole bunch of companies. And what happens in companies? Leadership rotates at those companies, right? They got John Jones one day, then they got Tyrone Jones the next day, right? Or Susan, and then next year is John or Dave. Everybody got a. Why do every company have, or every place you work, they got a supervisor named Dave, right? But anyway, that's another story. The point is that companies go in cycles. The companies in your bucket go in cycles. Companies take on new capital. Companies make fundamental changes all the time. Now, listen, I got to say this because a lot of people don't think about this when it comes to ETF. I know that ETFs, just like index funds, they have a wonderful built-in mechanism called self-cleansing. What is self-cleansing when it comes to an ETF? Well, self-cleansing is the automatic process where an index removes underperforming companies, kicks them out of the bucket, and replaces them with new growing companies in the bucket. And we ain't got to do nothing. That's the beauty of ETFs, right? They kind of self-cleanse themselves. And that's why they're considered a passive investment. But you have to always remember, even though the ETF is self-cleansing itself, remember the ETFs that did well last year, they could underperform this year or next year, right? So you got to be careful when you're evaluating which ETFs to actually buy. Be careful about chasing the last year or 5 years great performers. That's just, you don't want to follow the crowd, right? And just react instead of thinking. And here's the bigger issue. If performance is your main reason for choosing an ETF, you're already off track. I'll say it again, if performance is your main reason for choosing an ETF, you're doing it wrong. There's other more important things to look at when determining whether or not to buy an ETF or not. The main thing is, does it have the potential to meet the goal that you want to accomplish? Now, don't get me wrong, performance matters, but it's one of many factors, okay? Not the main factor. When last year performance becomes the reason, you're only picking the ETF based on a tiny little piece of criteria from last year or 5 years ago. Some people use performance as the only thing that they're tracking, that they're buying ETFs based on. Right? Again, hit that like button for me. You got to smash the like button. You got to drop me a comment if you're watching this on replay. Let me go to the fifth mistake. Guys, do me a favor. If you enjoy these type of lives, let me know. Just give me a 1 in the chat if you enjoy these type of lives every now and then. I used to do 2 lives a week for about a year and a half on my channel. And I kind of stopped doing a lot of lives. But if you enjoyed the lives, put a 1 in the chat for me so I see if we got some folks that like it. If you don't enjoy the lives, put a 2. I dare you. No, I'm just kidding. Put a 2 if you don't enjoy, but put a 1 if these lives may be sort of helpful for you. I'm just curious. Thank you. I appreciate that. We got a few of them in there. Excellent. Excellent. We getting there. We getting there. Who said that? I can't find her. Okay. Celine, we're getting there. Lots of 1s. Thank you, guys. Appreciate it. Okay, now, last one. 5th mistake that smart ETF mistake that smart investors make, right? And this one gets overlooked because people assume that ETFs, they're cheap because they're considered passively managed, right? So watch this. Somebody said it earlier. People ignore the cost of owning an ETF. Big mistake by smart investors. Yes, ETFs are generally low cost, but not all ETFs are the same. You'll see, and I wish I had my graphic up here, but I dig more into this in our 4-step financial reset. But you'll see somebody choose a fund, an ETF, with a 0.50 expense ratio, when they could have bought the almost identical ETF with only a 0.03 expense ratio. So let me just tell you a quick, okay, if you have $100,000 invested, and I wish I had a visual for this, so visual learners, don't beat me up. But if you have a $100,000 investment, a 0.5 expense ratio, you're going to pay $500 annually just to own the $100,000 that you have in that ETF. Cost you have $100,000, you have a 0.5 expense ratio, you're paying $500 a year. If you had a 0.03 expense ratio with the same $100,000, you'd only be paying about $30 a year to own the fund. So $500 versus $30. That's a $470 difference, right? In the first year, because you chose the 0.5 expense ratio versus the 0.03 expense ratio. You paid an extra $470 the first year. Now, over 20 or 25 years, that difference compounds. And ultimately, you might have $30,000 less, $40,000, $50,000, $80,000 less in your total returns because you chose a more expensive ETF to own, had a higher expense ratio. And I know $470 a year, oh, that sounds small, but that gap compounds and compounds and compounds. And it's easy. You get around 900,000, 1.5 million invested, and you got a whole bunch of all your stocks are 0.5 expense ratios when you could have had 0.03. That could amount to, tens of thousands of dollars over the course of 15, 20 years or more. So at the end of 20 years, you could have $1 million or you could have 900,000. I'll take the million. So one mistake, this final mistake that you got to understand is that you're paying to own the ETF. So you have to pay attention to what it costs. And what it costs is outlined in your expense ratio. So a 0.03, let me just explain this because this is kind of a 0.03 expense ratio means you pay $3 for every $10,000 that you have invested. If your ETF has a 0.03 expense ratio, $3 per every $10,000 that you own per year. An expense ratio that I mentioned in that previous example of 0.5, which is much higher than 0.03, but 0.5 means that you're going to pay $50 for every $10,000 that you own in that ETF that charges a 0.5 expense ratio every year, right? So you have to know that even these small percentages matter over long periods of time when it comes to expense ratios, right? And let me say this, like I got to say, let me not forget this. Use AI. If you're looking to compare 2 or 3 different ETFs, you can go to ETF.com, but you can also go to Claude. You can go to ChatGPT or Google, right? Gemini, right? Whatever. Use AI to help you with some of this information, right? I'm just looking at a couple of the chats. Appreciate you being here. So when you step back and look at these 5 mistakes, these aren't just ETF mistakes. These are really kind of mistakes to our approach to ETFs. Even smart investors do this, right? These mistakes come from not having structure, not having systems, not having goals. And this is really why I always put investing as step 4 out of 4. I've got a system called the 4 steps to maximize your money. Investing is last. Because if your mindset's not right and your approach is not right, and you got a bunch of bad debt, or you don't have no savings, or your management and your systems, and you don't have a budget, and your money's not right, then your investing choices are not good. If you're taking the shortcut through life with your money, you'll probably want to take the shortcuts when it comes to investing. Not the right way to invest. A lot of YouTubers ain't going to tell you this. A lot of YouTubers just want you to click on their video. A lot of YouTubers just want you to click on the video, watch that 8, 9, 10-minute video. And if you didn't know, videos that are 8 minutes or more are monetized on YouTube. That's why most videos you see are 8, 9, 10 minutes long, or 13, 15 minutes long. They're over 8 minutes because that's when ads are able to go into your video. They'll just do a video with a fancy thumbnail, and they just want you to click the video. They don't care that you really understand this stuff. That's not their goal. The goal is to make money off you watching them on YouTube. So they're not going to break this thing down. They're going to go jump into a video and say, hey, my 3 top stocks. Let me show you. Because they're satisfying your want to get the quick answers, but I'm trying to give you the right way to approach it, which is different, right? Now, this is why I built the 4-step financial reset. I got to mention it because it's super important. We dig into this stuff in the third small group coaching session. We dig into this stuff, the investing stuff. Most people don't need a bunch of ETF ideas. They need structure. They need the right approach with their money and their investment choices. People need a system that they can follow. That's their system. You don't need to follow my system. You don't need to follow Susie Orman's system. You don't need to follow Kramer's system or Dave Ramsey's system. You need to follow your system because everybody's situation is different. And that's what we do in the 4-step financial reset. We help you create a system that's right for you. Right? And so we put all these steps together. I mentioned a few minutes ago, your mindset, your day-to-day, everyday assets that's around you, your money management, and your investing, how you plan to invest. What's your approach to investing? What is your core beliefs and philosophy about investing? So if you're serious about getting this whole thing right and you want to build a financial system for yourself, feel free. There's a link in the description box below that is of the 4-step financial reset. And it's not theory. We're not playing in theories. It's not hype. We're not hyping you up and motivating you. It's a structured process to help you take control of your money and ultimately invest the right way, right? But if you're ready for that, there's a link in the description box below. You can peep that out. And if you're not, listen, no heat, no judgment over here. You got 5 steps, 5 mistakes that you need to take seriously if you're an investor in ETF. That's free game. Right? But you can at least do me a favor and hit that thumbs up button. Very important you hit that thumbs up button for me. And also important that you look in the description box of YouTube. There might be something for you. There's our 4-step financial reset, but we got a bunch of other ways to stay in touch. We got our Patreon. We got other stuff. We got free stuff in that description box as well. Any questions? Let me just double back and see if we got any questions. I'm trying to find the questions. If you type one earlier, you might want to type it again if you want. I'm going to answer a few of them before I get out of here, guys. Let's see here. Monetization, if your money. Let's see. I have made a major turn since reading. Excellent. I'm not sure what you read, but what'd you read? Somebody said, why would I want to pick stocks? I do have a small portfolio of stocks. Somebody said, what about gold? Gold is fine. I look at gold and silver, any of the precious metals or commodities for that matter. I look at those things as more insurance, especially gold and silver, as more insurance because they don't have no real, like I got to sell gold in order to make money on gold, right? I mean, I can have an ETF or something, a gold ETF or something. But if we're talking about physical gold, I look at it as more of if everything collapses and stock market is no more, I got my gold, I got my ammo. We can talk about that some other time. Let me see. Somebody said, how about healthcare? Healthcare is a fine sector to be in. I don't personally own a lot of healthcare at all. It's just not my space. I always try to be in spaces where I feel that I have some competency in when I'm investing, right? Do I think SCHD is still viable? I don't own SCHD. And so seems like it was a little rocky for a minute there, but I think it's done well for a lot of people. Somebody said it was wise to pay off. Is it wise to pay off debt first, then invest? Here's what I suggest. That's a great question. Let me answer this question because it's really important. I suggest that you first, before you jump both feet into investing, you first take care of all your basics. And the very first thing is if you got a job that offers a 401k with a match, get the match. Get the match while you do all that stuff. Go ahead and get the match. And if you have a job that doesn't offer a match, I suggest people open up a brokerage account, put 3 to 4% of your money in that brokerage account, leave it, don't mess with it. Just every time you get paid, 3 or 4% of your money goes there. In the meantime, build out a full emergency fund. In the meantime, pay off the bad debt. The reason is this: I don't want you investing 20% of your money, but you can't even cover if the tires on the car go out, right? I want you to do the little matching or the 3 to 4% at a brokerage, but in the meantime, take care of all the other stuff to get your foundation together. And once you do that, then go ahead and invest a whole bunch more money. That's the order that I think you should be in. Let's see here. Should I save for physical real estate or try out REITs? Depends on what your tolerance is. I've owned real estate for 26 years. And even if you have a property manager, you still got to manage the property manager a lot of times. A lot of times property managements can be shaky, right? They're shady just like everybody else. So if you plan to have physical real estate that you manage or you have a manager manage, you got to be prepared for that mentally. Check out, I got 100 videos about real estate on my YouTube channel in one of my playlists. Check out some of those because I go into real in-depth stuff about physical real estate. I haven't done a lot of real estate videos lately though, but you could do both if you really like them. You could, if you don't want to, turn a wrench or find up somebody to maintenance your properties or whatever, then you might want to go REITs. Totally up to you. It's really about what you can tolerate. NVIDIA is still great individual stock to invest in. I like NVIDIA. This is not investing advice. I don't give investing advice, but I was making YouTube videos about NVIDIA 2 years ago before that last split. I was making YouTube videos about Palantir when they was $18 a share, right? So we've been doing this thing for quite a while. Let's see here. If I was 18, I would get a Roth IRA. Let's see. If you were 18 last year, what's your mindset? If I'm 18, yeah, I would try to pay cash for most things unless it's an appreciating item that's going up in value. And I would just invest, I'd max out the Roth. I think somebody said that I'd max out the Roth and I would just invest and be careful, right? Know who you are investing. You can take a little bit of risk here and there, but you got a big runway. When you're 18, you got the most important thing you could have when it comes to investing, which is time, right? Somebody said, how and where do you find a good property manager for your real estate? The best thing to do is to join your local real estate association and ask other landlords. Boom. That's how you do it. It's tough because property management companies go in and out of business all the time, right? And sometimes it's just somebody sitting at their desk on a phone, right? Managing, who is the property management company. One person sitting at a phone, right? So the best way to do it is to get to know other real estate investors near and around you and start checking with them who they would suggest you go with as a property manager. That's what I would do. Let's see here. Do you ever withhold investing in a company for moral reasons? Me personally, yes. If it's a company that I don't feel good about in terms of what they do and what they produce and what they support, don't support, I look at that type of thing, right? That's me personally. Some people don't care about that. They just go ahead and invest and don't care, right? That company could be selling something that is totally against their morals as long as they're making money. I'm not really like that. I like to have some integrity in my investing because I think ultimately I want to get behind and be a champion and a cheerleader for the companies that I'm investing in, right? And it's not perfect. I'm not perfect with it, right? I might have made some mistakes here and there. So here's the deal, guys. 5 ETF mistakes smart investors make. If these 5 ETF mistakes helped you, or if they gave you something to think about, do me a favor, drop me a comment below if you're watching this on replay, share the video, the link, push it out there. Everybody sitting in this video right now, you know 1 or 2 people who could use this information. And you got to smash the like button for me. All right? Listen, I hope to see you in our next 4-step financial reset. It is a course that you take on your own in your own time. And then it's 3 live small group coaching sessions that we do. And each of those sessions last about 90 minutes to 2 hours. So this is real sort of one-on-one in a small group setting that you have in terms of the 4-step financial reset. Plus, it's a bunch of workbook. It's a huge workbook. It's a bunch of handouts for you to start getting better with your money and being a participant, not just a listener on LinkedIn or a listener on YouTube or a listener on Instagram. Stop listening and start doing. That's the only way you're going to get better with your money, right? So I hope to see you in our next 4-step financial reset. Enrollment's open right now. If you got a question, drop it in the comments. I usually check out the comments to these lives. So as I always say, guys, the absolute best person who's going to take care of that old you is the young you. You guys take good care of yourself and take care of other people. Until the next video, peace.